Hello, everybody. Happy New Year. Welcome to Macro Money. This is the first show of this new year. Welcome to 2023. I am Ilya Spivak, head of global macro at tastylive. We're going to launch right into our coverage of these macro markets in this new year and jump right into some key economic developments that we are looking at this week. And of course, we begin with what is probably going to be the first round of major economic news on the docket. We're going to have, of course, the very closely watched U.S. jobs report. And that'll be coming up later in the week, and we'll talk about that on the show later in the week. We'll do a preview of those numbers. But for now, we are going to take a look at the two pieces of news that are going to cross the wires tomorrow. The first one is the JOLTS report. Now, this is a very important piece of data. What this does is it tracks, it's a survey, it tracks job openings and various different sort of elements of job transition. So it'll track hirings, it'll track people that leave work, and so whether voluntarily or not. So it'll track quits. A very good survey that factors into what the Fed is thinking. We're also going to get minutes from the Fed's fateful December policy meeting and get a sense of how that went. And at the end of this, really where we want to land is how will these releases shape for us what the markets are thinking, where the market's head is at. We'll talk a little bit more this session with Chris and get a sense for how the markets are doing today and what that price action means. What we want to really distill here is what is it that the markets care about? Last year, they cared about the Fed rate hike cycle. What do they care about this year? Is this still where we are expecting to have much of the narrative, or are we looking at something different? Is there a different lens through which markets are looking at what's occurring here? And can we see in the response to these releases and how we might frame them a bit of a clue about where that thinking is? So let's first take a look here at this JOLTS report. And what we're focused on is the jobs opening number. Now, this is in thousands. So what you're seeing here is thousands, or essentially millions of job openings. So what we're expecting is that in November, we're going to come down to 10 million job openings in the U.S. And you can see this has been moving lower since March. So we reached a peak just underneath the 12 million mark earlier in the year last year, and we've been moving lower ever since. And what we're expecting to see this go around is a 17-month low. Now, obviously, the key question that ought to be on our mind is, why do we care? There is, of course, the sort of superficial reason that one would want to see that job openings in the U.S. have been moving lower for the better part of 9 months. But it is interesting, of course, why this is occurring. So let's take a look and notice here, this first chart looks at all of the key indicators in this JOLTS survey. And the yellow area that I've outlined here really is showing us the complete picture. So you can see that job openings are down, but also hiring is trending lower. Meanwhile, quits are stabilizing and drifting down a bit more. So fewer people are quitting their jobs, fewer people are being hired, and there are fewer job openings, right? All of this collectively speaks to a slowdown in the labor market. So people are not as comfortable leaving their jobs because they think they're going to find another one quickly. Hiring, not surprisingly, given that backstory, is slowing, which of course would explain, at least in part, what's going on with quits. And you can see demand for labor seems to be cooling because job openings are coming down. So what we're witnessing here, really since basically the end of the first quarter of last year into the remainder of last year and at the start of this year now, is a broad-based deceleration in the U.S. labor market. Now, what does this mean? So this is obviously a critical consideration, and this might feel a little bit counterintuitive initially. So let's take a bit of time with this and unpack it. The orange line that you see there is average hourly earnings year-on-year rate. So what we're looking at is we're taking average hourly earnings in a given month, and that's part of the U.S. jobs report that we get once a month. We're going to get an update on this number on Friday. This is a measure of wage inflation. So we're looking at where those average hourly earnings are in a given month. We're comparing them to where they were in the same month a year before and getting something that is a proxy for wage growth as it lines up with the usual headline inflation numbers that we're looking at, trying to get a sense for what is that sticky labor component in inflation. This is, of course, one of the critical reasons why the Fed's gambit, and in many ways the market's own gambit, on quote-unquote transitory inflation didn't really work out. And this is something that I've been talking about really for over a year now, which is that when you get this kind of inflationary situation, it comes in two parts. There is the part that's the more supply side and the more influenced by disrupted supply chains, uneven COVID reopening around the world, and so issues in the supply of goods there. There's disruption to commodities supply, in part geopolitical because of the war in Ukraine. And so those are all things that perhaps are, quote unquote, transitory in the sense that supply chains mend over time, wars end over time. These are things that, with some introduction of time and policy to mitigate the impact, would be something that you would expect to filter out of inflation. Wages are stickier because what happens is when you get an inflationary spike and it feeds back into wages, so the price of goods and services, the cost of living, if you will, for folks goes up, they start to demand higher wages. When you get the kind of dramatic fiscal stimulus that we've seen, then you have quite a bit of influence there, in the sense that people have a degree of backstop on their incomes. They can be a little bit more choosy with where they're finding work and with what those terms are, especially in the past several years, as people have cared more about working from home and staying away from crowded offices. So you have a situation here where as those costs go up, labor starts to demand higher wages and is not as readily jumping on some of these jobs. And so you see a parallel rise in job openings as companies attempt to fill them with reopening underway, and wages going up, showing that companies are having to compete for labor by offering higher wages. Now, once those lock in, they're not like supply chain disruptions in the sense that once things ease on that supply side, those wages are not going to adjust back down. That's not how wages work generally. Once a wage contract is signed, it doesn't generally adjust down with inflation, only up. And so that creates a stickiness in the costs of labor, which feeds into the cost of everything else and keeps inflation more durable and stickier. And of course, then the only way to really adjust that is to slow the economy such that some of those jobs begin to go away. And so what you see then is as job openings come down, so too wage inflation is cooling. And of course, this is a major input into the Fed's calculus. We've heard the Fed talk about this quite a bit, that to really bring inflation down, they need to slow the economy so that this wage component is a part of bringing inflation down. So this is a by design slowdown of U.S. jobs creation that we're looking at. And you can see how that filters into inflation expectations. So again, as job openings come down, what you're also seeing is that the priced in expectations for inflation that are baked into bond markets, this is the 5-year U.S. break-even rate, which is the inflation adjustment in between nominal, which is sort of your garden variety U.S. bonds, and the inflation adjusted kind, the TIPS securities, which factor inflation out. Well, when you take the difference in yields between equal maturity nominal and inflation adjusted or quote unquote real rates, what you end up with is the magnitude of the inflation adjustment that you need to get from one to the other. And that's the market's expectation of inflation, actually as priced into bond markets, as opposed to some survey of economists or somebody's opinion or some such thing. So what we're looking at is the market's own perception of where inflation is going. And you can see that since early last year, inflation expectations have actually been coming down. Not all the way down, of course, to where the Fed wants them. At a 5-year horizon, they're still north of the 2% target. But nevertheless, the trend has been down, and a deceleration of the jobs market has been very much a part of that story. So with that in mind, we're going to look at these JOLTS numbers when they come out tomorrow, and we're going to see, do we get that 10 million number? Do we get less? Do we get more? If we get less, that would suggest that what the Fed is doing is working better than markets anticipated and might cement, on the one hand, the view that the Fed is going to, in fact, wrap up the rate hike cycle, at least this phase of it, on schedule as markets expect. We'll see what that means in just a moment. And if they were to come in higher, that means labor demand is still hotter than is necessary to bring inflation to heel. And you might get a degree of concern around that in markets because the Fed might be seen as needing to do more than what is currently anticipated. Now, what is it that the Fed is doing? What is it that they're expected to do, and how might this factor into this story? Let's take that next leap, and let's go deep. So the second thing that's going to come out tomorrow that's going to be critical. Following these JOLTS numbers will be minutes from the Fed's December FOMC meeting. This is the policy meeting most recently. It occurred on the 14th of December, so just about half a month ago. And so here, these are going to be outtakes from the discussion that led to that policy meeting. Now, I say outtakes because these are not minutes in the strict transcription sense. We're not going to get verbatim exactly what was said. What we're going to get is a shaped document that will give markets a sense of how the conversation went, what different people brought up, and how all of this distilled into the policy decision and into the set of forecasts that we got. So let's take a look at what that is. And there are a couple critical takeaways here. This is the Fed's December summary of economic projections. These are released once every quarter. And what you see here is the Fed is betting that 2023 will be about stagflation. So in other words, slow growth, elevated inflation. So you can see the core inflation rate adjusted September to December from 3.1 to 3.5% in the forecast. The growth projection adjusted aggressively down from 1.2 to just 0.5%. And then the rates path, as we see it in the projection for this year, next year, and the year after, basically moves in increments of 1% or 100 basis points year to year. So we're expecting to hit 5.1 this year. And then by 2024, we're already 100 basis points back down to 4.1. Subsequent year, we're back down another 100 basis points to 3.1. In other words, what the Fed is telling us is here is restrictive monetary policy hurting growth with an eye to curb inflation and a 3-year window for how that's going to look. With 2023 then along the way being a stagflationary year where inflation is still high, growth is very weak. Now, is there anything here that might show up in the minutes that the markets aren't ready for? Well, let's see how they onboarded the announcement initially. The chart you see here, the solid line is the current expected Fed policy curve. This is, again, market implied rates coming from the rates futures market, Fed funds futures. The dotted line is what was there as of that last Fed policy announcement. So this is the shift you've seen in the past, let's call it 2 weeks or so. What you see is that the terminal rate for the rate hike cycle is in 6 months, which essentially would mean June. So you can see there, it was a little bit higher. It was sort of on approach to 5.5%. It's been revised down to about 5%. Now, looking back at the Fed's expectations, 5.1 for this year. So it looks like the markets and the Fed are about in line. Looking out about a year and a half into 2024, we're on the way to 4. That's exactly what we'd expect to see here. Looking out into 2025, we're down to 3. So again, very much in line with the Fed's expectations. So it looks like the market is about where the Fed estimates had them guided. And so it could be that there's not really a whole lot that these minutes do as long as they don't change this calculus. Let's take it a step further. If we know that the markets currently expect rates to peak in June, this is the futures implied Fed funds rate in June. So this is what the markets actually expect for June. Notice that since the beginning of November, this curve hasn't really moved much. So it's been oscillating basically between 5.1 and let's call it 4.8. So give or take 10, 15 basis points around that 5 level. But generally speaking, it doesn't look like the December policy announcement really changed anything for markets. And it doesn't really seem like we are too removed from where the Fed is. So it could be that what we end up with from these JOLTS numbers and from the FOMC minutes is basically the status quo. The U.S. labor market is slowing. The Fed tightening already underway is doing that work. And from Fed minutes, we are perhaps looking at about a market that's baked in for where the Fed thinks they're going. So not much of a surprise there. So what does this mean for actual market action? Well, if there's not a whole lot to see here, then we would expect that the market would then move on, get past the event risk, and go to whatever the default is. And of course, then the power of watching this data becomes, what is that default? What is the market's natural kind of path of least resistance when data doesn't throw it off course, when surprises don't necessitate a rebalancing of portfolios? Well, I think we got a little bit of a taste of it today in markets, and we'll talk about this in just a moment. But to give a sense, and this, by the way, is another indicator that's due tomorrow, the ISM manufacturing survey. This is Institute of Supply Management version of a purchasing managers index. Works exactly the same way. 50 and above is growth, 50 and below is contraction. We're expecting deeper contraction on that indicator. So you can see that black line there is the ISM manufacturing index. It is already sub 50, and the next one is expected to be even deeper, so from 49 down into the 48 area. You can see against that backdrop there, 3 months now of coordinated contraction in all of the world's major markets and the global composite as a whole. The UK, the US, the Eurozone, and China, all shrinking, and all shrinking by an increasingly significant speed. So the further we get under 50, the faster the contraction is occurring. And you can see that contraction is speeding up. That, of course, is the consequence of Fed tightening, of a global increase in borrowing costs. Now, compare this with this chart that we looked at last week, showing that in the very long period between easing and hiking in this last sequence, we've looked at essentially 84 months of a gap between where the last major easing cycle around the great financial crisis ended. There was obviously a big blip there for COVID, but we, of course, are not looking at something that's long-lived or something that's even moved policy rates very much as far as their impact on borrowing costs market-wide. We'll take a look at that in just a second. But what we see is this kind of very quick aborted rate hike cycle from about 2015 through late 2017, early 2018, and then things abruptly end. Of course, shortly thereafter, we have COVID and aggressive easing again. So washing that brief thing out of the picture and looking at the last major easing cycle where we went from meaningfully positive rates down to zero and then did QE, and then this most recent tightening cycle where we finally get off the mat and start pushing rates higher, the global economy has accumulated $90 trillion in additional debt. Debt that will now be increasingly more difficult to service, not only because the global economy is shrinking, and so debt is becoming a bigger share relative to GDP, and so debt service costs start to eat up demand, but also, of course, because those debt service costs, where they're rolling over, now need to be financed at much, much higher borrowing costs. And so perhaps then the market default is no longer speculating on Fed monetary policy in the near term, in the length and amplitude of the current rate hike cycle, and much more about its consequences. And so this is a chart we're revisiting from last week. The yellow backdrop there is the Fed funds rate. You can see most recently, of course, it surged. You can also see the 2015 to 2018, 2019 rate hike cycle really doesn't drive much of a change in underlying borrowing costs. That's the green line there, the TED spread, which is the cost of U.S. dollar financing in the U.S. and offshore. That gives you a sense of any potential liquidity shortages or cash shortages. You can see that that long period in between the end of the rate cut cycle addressing the global financial crisis in '08 really is a long, long lull in meaningful movement in borrowing costs until this most recent spike. So you're seeing a level of stress in markets already. So if these JOLTS numbers end up being status quo, if these FOMC minutes end up being status quo, the market may then default to something very akin to what we saw in markets today, which is risk aversion that naturally presents itself as liquidation across global markets.